Good afternoon to our esteemed NRIs joining from Singapore. On behalf of Ashutosh Financial Services Private Limited, I, Premji Fufal, extend a warm welcome to each one of you for this insightful and focused webinar on changing landscape of taxation, regulations, and investments in India. We are honored to have you with us today as we discuss key financial aspects for NRIs. India's financial and regulatory framework is evolving, and staying informed is essential to optimize investments and tax strategies. Today's session will focus on three key areas: Singapore NRIs for taxation and regulations, Singapore NRIs for investments and insurance, opportunities for Singapore NRIs through GIFT City. We will now proceed with a short introductory video of CA and CFP, Mr. Rajit Kothari. Following this, I would like to invite our esteemed friend and client, Mr. Bhavesh Dalal, to share a few words. Thereafter, Mr. Daxesh Kothari will deliver his introductory remarks, after which we will hear from CA and CFP, Mr. Rajit Kothari. Following the presentation, we will open the floor for a Q&A session where you can share your questions in the comment section and we will address them during the session. Thank you.
Mr. Rajit Kothari is the Executive Director of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He is a chartered accountant and a certified financial planner by qualification. Further, he has graduated in the field of commerce with specialization in banking, financial services and insurance sector from Ahmedabad University and has also pursued post-graduation in the field of law. He started his journey with Ashutosh Financial Services Private Limited, where he played an instrumental role in functioning of several business development activities of the company. He also played a vital responsibility in the development of exotic product offerings for the company in the alternate investment arena, such as foreign equity and unlisted stocks. Moreover, he was instrumental in the preparation of extensive knowledge database on different topics concerning taxation and finance for the company. Thereafter, he worked with Messrs. Deloitte Haskins and Sells LLP, one of the leading global consulting firms at Mumbai, focusing on tax and regulatory compliance for high net worth resident and non-resident individuals. He is an expressive public speaker and addresses professional forums on diverse topics related to finance as well as other topics of national importance. He has participated in international exchange program as a student and has also attended management development programs across top business schools in India. As a young and dynamic director with a multi-skilled personality, he presently concentrates on exploring innovative business opportunities through geographical expansion, digital proliferation, and concentric diversification of the company.
Good afternoon. Thank you, Premji. It is with a lot of pleasure and a lot of delight that I invite our friends, and I have been associating with Rajit Bhai and Daxesh Bhai since the time they have made their presence back in Singapore. I understood them well. They had a seminar at the Singapore Swimming Club where they addressed a lot of NRIs, our key pain points, our concerns, our wealth accumulation goals back in India, and the alternatives that India provides. As correctly put, it's a dynamic, evolving economy with constantly changing taxations, landscapes, and I think more to come. So with all that in mind, when I was, sorry, there's a bit of echo. Yep. When I actually met up with them, I understood how they work. They understand the NRI business, not just limited to Singapore. I believe they have clients globally, to name a few, UK and Dubai. Since then, me and some of my clients have been associating with them in terms of they handling some of our portfolios back in India and giving us the much needed guidance and advisory, rather than just pushing a product or giving us some helicopter view. They're always very detailed, and it's been a joy working with them. So this idea of this entire webinar was more of a reverse inquiry when a lot of my friends and my clients actually asked me that, Bhavesh, what do you do back in India? So I have been in Singapore for the last 30 years, as some of you know. So when it comes to India, a lot of those things that are constantly changing and evolving are sometimes so fast paced that we are not able to keep in touch. So that's the reason I thought I would introduce Rajit Bhai and Daxesh Bhai today to some of you. And if you have any concerns, any feedbacks, or any questions, please feel free to ask. And I assure this is going to be definitely a enlightening and an enriching session. Thank you. Pass it over back to you, Premji Bhai.
Thank you, Bhavesh Bhai. Daxesh Bhai, we request you to please take up your session.
Hello, everybody, and a warm good afternoon to everybody out there in Singapore. And thank you very much, Bhavesh Bhai, for those very nice words and, very apt start to the webinar, introducing us very nicely and setting up the context. As my opening remarks, I would like to talk about the state of the Indian economy in a little brief. Today, talking about any economy in the world, and especially the Indian economy, we need to be cognizant about the fact what are the winds of change which are blowing across the world. And when it comes to India, those winds are a little strong. The reason is that US has inflicted 25% tariff on India, and the next week, an additional 25% of tariff is going to be operational on the basis of whatever announcements have been made. 50% tariff on goods of any country is quite absolutely rather unworkable. And this is the highest rate of tariff which US has imposed. The another country which is in that bracket is Brazil, which is also going to face a tariff of 50%. But the good part is that there are a few important sectors which are out of the tariff ambit. The first being export of pharmaceuticals, the another being export of IT services, because these tariffs are on goods and not services, and India has a lot of export of IT services. And the third important sector which is not impacted by this tariff is electronic goods. Today, India is a major manufacturer of phones for big brands like Apple and Samsung, but these tariffs are not going to impact the export of these goods. But definitely, there are several sectors which are going to get impacted by these tariffs. But unlike Singapore, which is a country which is driven or which has built itself on free trade, India is a country which has been built on self-consumption, and the extent of foreign trade or export for India is quite limited. But definitely, it is going to impact India. The estimates are that India, which is a country which is growing at a rate of 6.5% on real GDP basis, there could be a decline of at least 0.5% on account of these tariffs if they get operational across the year. But India is preparing in its own way. The BRICS setup is getting rejuvenated and the realignment of BRICS is happening. The Indian Prime Minister is visiting Shanghai in the next week, and that is going to bring the entire BRICS setup with a new kind of integration, which is going to benefit, and it will set up a stage for India to deal with these kinds of tariffs. And it has been observed that India has always been resilient in the times when there has been some kind of a challenge. When it comes to the macros of India, the Indian monetary policy, the policy of the interest rates by the Reserve Bank of India has been quite helpful. In last 1 year, there has been a reduction of 1%, 100 basis point in the repo rate. And now the repo rate in India is 5.5%. Inflation in India, the consumer price index inflation in India is quite under control, which is just 1.55% on the basis of the figures released for the month of July 2025. On the fiscal front, the fiscal deficit estimated in the union budget for 25-26 is just 4.4% of GDP. When we compare this fiscal deficit with the fiscal deficit of US, which is at 6.1% of GDP, India's GDP, India's fiscal deficit is quite in a band which is quite acceptable. But whatever I have been saying are the pluses and the positive aspects for India. But everything is not hunky-dory. The consumer demand in India is slowing down, but the government is quite cognizant about it. And there is a set of GST, goods and services tax reforms, which are coming up in another couple of months, which is going to address this slowing consumer demand. Industrial production in India is growing at just 1.5%. In a country which is growing at a real GDP of 6.5%, and the industrial production is growing just by 1.5%, it is an area of concern. And the government is quite, as I said, is also cognizant about this aspect. It is building up the infrastructure which is required to see that the industry in India gets a lot of focus, and the next leg of growth in India is driven by the industrial development. Ease of doing business is also something which is up in the minds of government, and every day there is some measure or another which is being released to see that there is an ease of doing business. But we really don't know how the global headwinds will move. But all in all, the government is very cognizant and very mindful of whatever is happening on the economic front, and is duly concerned about anything which is happening either internationally or within the country, and wants to see that India by 2047 becomes a developed nation. With these opening introductory remarks, I would now hand over for the core presentation.
A very warm welcome and good afternoon to all the participants who have joined from Singapore. It's always a pleasure addressing all of you. This is our third webinar, especially for designed for the participants from Singapore, over and above the physical event that we had last year and a subsequent one that we plan to have later this year. Thank you so much to Bhavesh Bhai for the kind remarks initially, and to Mr. Daxesh Kothari for setting a tone on the Indian economy. moving further with the core presentation, we have divided the entire presentation into two parts, which is number one on the taxation and regulations front, and second is on the investments front. Starting with the regulations aspect, banking, as we know, is the core to any kind of financial activity that any NRI might have in India. So moving first with the banking related regulations, any NRI residing outside of India is not allowed to hold a resident Indian savings account. So it is advisable to either close it or convert it into an NRO account to remain compliant with the exchange control regulations. The NRO account is a non-repatriable account, meaning that the funds cannot be moved outside of India from the NRO account without following a certain procedures seamlessly. Also, whatever are the transactions and that are linked to a resident account are redesignated into an NRO account as soon as a person becomes an NRI and converts the bank accounts. And all the interest income from the NRO account is taxable in India, and it can be held as a joint account with any other resident. The loan is also available against it. NRE account is a repatriable account, and both are rupee denominated accounts, and it is freely repatriable outside of India. And any interest income from a NRE account is exempted or tax free in India. And similarly, it can be held jointly only with a relative, which is certain relatives as defined under law. FCNR is a form of deposit that is held in foreign currency in India, and the interest on this foreign currency deposit is also tax-free in India. There are several different currencies which are offered for these deposits in India, depending upon the needs of the particular investor. This can be availed. And similarly, a loan can also be availed in this. And this can also be a strategy which many investors are using to place deposits in foreign currency and then borrow in Indian rupee and invest in the Indian markets. This is a very important question that we always come across, which is moving funds from the NRO account to the NRE account, because whenever a person is a resident, there are a lot of funds lying in the NRO account. Also, so many of the credits are directly, there's so many of the transactions are directly credited to the NRO account, which is like a property sale proceed or any such similar kind of Indian financial activity, barring a few. All the proceeds are credited to the NRO account. So a lot of persons want to move this NRO account to an NRE so that it is repatriable. To make this possible, there is a scheme of the RBI wherein any amount to the extent of $1 million US per Indian financial year per person can be moved from the NRO to the NRE account or can be directly repatriated outside of India. And the only requirement is that the taxes on this should be paid, and there is a chartered accountant certification which needs to be complied. Thereafter, this can take place without any kind of additional approvals from the RBI or any other regulatory authorities. And this is, as such, a quite seamless process. The only thing is that the taxes on the proceeds which is lying in the NRO account should be paid, and the source from which the funds are credited should be clear and visible to the person, to the accountant who is certifying it. PAN is the taxpayer identification number of India, as many of you would be aware, and PAN is required basically to engage in any kind of financial activity by and large in India, right from opening a bank account to entering in any kind of transactions or doing any other investments or any other activity in India. As we are ushering into the tax filing season with the due date of the last day of filing tax returns being 15th of September for the financial year 24-25, we come across this question very frequently as to who is required to file an income tax return in India. Is it that any person who has a PAN in India is mandatorily required to file a tax return in India? Or is there a certain criteria to be fulfilled to be eligible and to necessitate the requirement of filing of tax return in India? These are the different criteria which make it necessary for any NRI to file a return in India. as we know now, there are two regimes of taxation, and most of the NRIs and also the resident individuals in India are opting for the new tax regime because of the benefits and the concessional tax of rates in that regime. In which there is if the income exceeds the minimum threshold, which is the basic exemption limit of 4 lakhs of rupees, only then a tax return is required to be filed. The second requirement or the second avenue where people find it worthwhile to file a return is even when they have an income lesser than this threshold, but they have got certain taxes that are deducted in form of TDS or withholding that has been done by the bank or any other institution, and someone wants to claim a refund of it, even then filing of a return is mandatory to ensure that the refund is credited to the bank account. The third area is when a person has incurred a loss, especially from any kind of a investing activity or any business or any kind of other activity or sale of a property, then if someone wants to set off this loss against other gains or carry it forward to be set off against any gains that might arise in the future years, even then filing of return is mandatory. Otherwise, this loss cannot be carried forward. And the fourth category is when a person is engaged in any kind of a meaningful financial transaction in India, which is mentioned in this list, which is depositing a substantial sum of money in bank, withdrawing money, or engaging in some kind of a business, or engage or spending certain money, certain levels of money in some way. And in all these scenarios, filing of return is also mandatory. Aadhaar card and OCI card. These are two important documents which many of the NRIs are often confused about. So we wanted to make it very clear in the minds of everyone as to what is the implication of these two and when is someone required to have them. So firstly, who is eligible to obtain Aadhaar? Number one, any person who has got an Indian passport is eligible to obtain Aadhaar irrespective of their stay in India. And number two, any person who is a foreign passport holder, let's say someone has got a Singapore passport or any other nationality passport, but has stayed in India for more than 182 days in the last 12 months, from the time when we are looking at this to evaluate the test for being eligible for Aadhaar. If this condition is satisfied, then a person is eligible to obtain Aadhaar. In any other situation, if none of these two conditions are satisfied, a person is not even eligible to obtain Aadhaar, and there is no mandatory requirement to have Aadhaar card in India for an NRI. And if someone is having a foreign passport and wants to invest in India, maybe in financial assets such as mutual funds, stocks, or even in real estate, then OCI card is mandatory. So OCI card, person has to be eligible to obtain an OCI card and is also required to obtain an OCI card to make this happen. As I mentioned, if someone already has a Aadhaar, let's say if someone had procured it way before when the person was living in India or was eligible to obtain Aadhaar, then it is mandatory to link it with the PAN. If someone is not having a Aadhaar, then a person in NRI who is outside of India not satisfying the requirements of having a Aadhaar, then that person is not it's not mandated to link it with the PAN. And as I mentioned, it is not mandatory to obtain a Aadhaar for any kind of financial activity in India for a NRI. There are many cases that we come across where the PAN has become inoperative because it is not linked with the Aadhaar. In this scenario, in case of a NRI, since that person is not eligible to have a Aadhaar, there is a procedure which has to be followed in which a set of documentation needs to be submitted to prove that the person is an NRI and not eligible to have Aadhaar. We have assisted several individuals in this. If you come across anyone who is facing this, then we can be of help to them. Now comes the situation of taxation as to how is taxation in India working for a Singapore-based individual. Firstly, one thing which we need to understand is that any incomes which arise in India, which is either earned in India or received in India or in any form is arising in India, is firstly taxable in India. Now, a person has got two options. A Singapore-based tax resident has got two options wherein a person can follow whatever is the rate prescribed under the Indian income tax law, or can go with the provisions under the India-Singapore DTAA. Is India has got a treaty with Singapore. There are several concessional tax rates and benefits that are there in this treaty, which any Singapore tax resident can avail. So a person can choose out of these two. If we go for a comparison of both these, which is the income tax rate in India and the concessional rates in DTAA, then this is the kind of tax treatment differential which is there, wherein any dividend or interest which is taxed at 20% or interest at slab rates, which goes as high as 30% and beyond, is taxed at a concessional rate of 15% under the India-Singapore DTAA, while in case of shares, maybe listed or unlisted, there is no concessional rate of tax under the DTAA. So whatever is the rate of tax that is applicable under the Indian income tax in India for NRI is applicable as such. As far as the mutual fund investments are concerned, may it be to equity or debt or even the pension incomes, then there is a tax-free provision which has been outlined in the India-Singapore DTAA, wherein if there is any Singapore-based tax resident who invests in Indian mutual funds or has got pension incomes in India, then under this DTAA, a person can have a complete tax exemption on whatever is the income arising out of capital gains or the pension income that is there from mutual funds or otherwise. While in case of the Indian income tax, there are higher rates of tax, which is the capital gains tax rate in case of mutual funds, and the pension income is taxable at the slab rates, which is 30% and beyond. Similarly, in case of the real estate, there is no concessional rate which is there. Whatever is the rate of income tax in India is applicable as such. Now, to avail this benefit of the DTAA, there are two ways a Singapore-based NRI can go about it. One way is wherein the person can sell the investments, and there is the withholding which is done by the mutual fund companies at the rates which are prescribed for any NRIs. And thereafter, once this withholding in terms of the TDS has been done, then a person can file the tax return and claim the refund of the taxes which has been deducted, which might take a few months depending upon the time when the investments were sold, because the return filing takes place in the month of May to July after the end of the Indian financial year. And the other option is that if someone does not want to go with this withholding, then there is an appropriate process in which a person needs to substantiate that he is a tax resident of Singapore, and thereafter there will be no withholding that will be done on the sale. If we go ahead with the first option, wherein if someone is fine with any withholding that is done and is ready to claim refund of the taxes at a later date, then these are the procedures which needs to be complied, wherein a certificate of tax residence needs to be obtained from IRS website in Singapore, which is very much possible and online accessible. Then there is a Form 10F which needs to be filed on the Indian Income Tax Portal, which we assist a lot of people in complying. And then the tax residency certificate as well as this Form 10F needs to be sent to the relevant financial institution in India. I'm sorry, this is the process when someone does not want any kind of withholding to be done by the asset management company. So if someone is wanting to go ahead with that option, wherein there is no withholding that needs to be done by the asset management company when the person is selling those mutual funds, then this certificate of residence plus Form 10F needs to be submitted to the mutual fund company. And once they are satisfied with the documentation, then they can go ahead with the redemption. While the second process, which I mentioned, wherein if they do not want to go ahead with this process, then they can directly obtain the tax residency certificate and submit it and file a Form 10F, and then directly file a tax return, after which the refund will be received. So this is the entire sequence of events that will be followed, wherein if there is an investment in Indian mutual funds that is done by a Singapore-based tax resident, be it equity or non-equity, and if those investments are redeemed, then a tax residency certificate needs to be obtained and a 10F needs to be filed. All this needs to be submitted to the asset management company, or needs to be submitted at the time of return filing, as the case may be. And then there will be no tax which would be implied on this kind of a transaction. This has also been supported by case laws in India. There is a common question that we receive, that if we are going with this process wherein we are claiming the refund of all the taxes, and if our total income is not crossing the basic exemption limit in India, are we still required to file a tax return? The answer to it is yes. If we are going with this TTAA benefit, any benefit, it could be the capital gain exemption or a concessional rate in case of the 15% which is applicable in case of dividends or interest, even then income tax return filing is mandatory, and we must file a tax return if we want to go ahead with the DTAA benefits. Moving further, going with the concept of succession, which is also a very important issue, as estate planning is also something which is very crucial in financial planning for any individual. What happens to the Indian assets that are there in India for a tax resident based out of Singapore once that person dies? Then we must understand that fundamentally the laws of succession in India are applicable for succession of those assets in India, be it the financial assets or the immovable assets, which are the properties or any other kinds of assets. These are the two ways in which the succession can take place, wherein if a person dies with a will, then there's something called as a testamentary succession, and the succession will be done as per what is mentioned in the will. And if a person dies without making a will, which is called as intestate succession in technical terms, then the succession is as per the respective personal succession law applicable, which is Hindu Succession Act in most cases. And whosoever are the legal heirs that are defined under the Hindu Succession Act are equal beneficiaries of all the assets that are lying in India. There is a common misconception amongst the several individuals that is nomination enough to ensure succession. Whenever we talk about making a will or the importance of estate planning, then normal answer that we receive from most of the individuals is that we have already made whosoever we want to have the successor as the nominees for those assets or investments. So we did not make any kind of further arrangements to this. One thing which we must understand is that the nominees are mere custodians, meaning they are having the custody of the assets in the death of the person who is holding, death of the person who owns the asset, but the real ownership title goes to the person whose name is mentioned in the will in case of a testamentary succession. In case when the will is not made, then as per the Hindu Succession Act, whosoever is the legal heir has got the title to it. So to give you an example, if a person has made the nominee as one of the family members, then all other family members, for example, in case of a male, the spouse, the wife, and the kids, all three or all two of them are equal owners in case the person dies without making a will under the Hindu Succession Act, despite of the fact that only one person has been made as the nominee. So the other persons will also have an equal entitlement to the ownership and will claim that asset from the person who gets the custody of it. So we must understand difference between these two and be mindful of that. Whenever we talk about the implication of this and someone understands the importance of making a will in India, then they wait for them to visit India to make a will. However, a will can be prepared by a person who is outside of India, and that has got as much validity as it has as if it is made in India. So it can be made very much outside of India. The only requirement is that it should have essentials of a valid will. It should be signed by the person who is preparing naturally and should be supported by two witnesses in presence of a notary public in Singapore or in any part of the world where the will is made. And the declaration by both the witnesses is something which is very mandatory, and the legal term of that is affidavit. and that should be also be executed before a notary public, affirming that they have acted as a witness to the will. Moving with the second part, which is investments and insurance in this session. So, firstly, let us first understand the present context of the Indian economy as to where we are. If we look at the current growth rate, then India is the fastest growing economy amongst the top 20 economies of the world. So, it is a clear no-brainer that we must participate where growth lies. And India today, the kind of growth that it is witnessing is phenomenal. Also, if we look at the barometer of the economy, which is the stock market, then the Indian indices, especially the mid cap and the small cap, have been the fastest growing benchmark indices in the entire world in the last 3 years on a compounded basis, surpassing all other emerging economies, including the other economies that we look at, and also the developed economies naturally. And if we compare it with Singapore, then we can see a substantial kind of a differential in terms of the growth that is there in the Indian markets. Now, let us understand as to what are the drivers for this economic resurgence that I am talking about. First and foremost is the demographic, the young, thriving population that we have in India, which is close to becoming the largest in the world. And interestingly, this is the youngest in the world, comprising of all the Gen Zs and the millennials like me who are ready to take India to its next level of growth. Democracy, we know the kind of stable government that India has witnessed in the last more than a decade now. And the fiscal deficit, as we discussed in the earlier part of this presentation, is quite under control, which keeps the inflation in check. And there are a lot of tax reforms, along with the introduction of the GST, as well as the income tax that has come up in the last few years, along with several other business-oriented policies, which has improved the ease of doing business in India sharply. Also, the thing to be noted is that there is a continuous set of these reforms. So we are still talking about GST 2.0 to revamp the entire structure. So this ongoing slew of measures is something which has kept the economy resurgent. The capital markets are also very efficient these days and are respected for its efficiency across the globe. The public sector undertakings have seen a sharp revival in the last few years. The central bank, which is the Reserve Bank of India, has been commended for its credit control measures to control any kind of chances of any financial distress to the economy. Geopolitically, as we know, the kind of winds that are blowing in right now, even then, India has remained to be connected very powerfully with all the major superpowers and without taking any major sides, and has been able to position the entire policy to its own economic interest. Digitization and financialization, these are two buzzwords prevailing in the economy right now. India has got the cheapest data in the world, and UPI has been a revolution. The kind of change that it has impacted the entire population is unprecedented. And also financialization is a trend that is coming up, that started coming up in India, with the systematic investment plans into Indian equity mutual funds crossing as high as 27,000 crore rupees every month. So today, every person in India has started understanding the importance of savings and channelizing that savings into capital formation in the stock market. India today is the fastest growing consumer market in the world, and the major consumption is moving from the unorganized players who are unstructured and not registered on the formal structure to organized players who are as such in the registered in the framework. And the tax relief of the government in the income tax front this year onwards, along with the GST cuts that might come in, will give a lot of relief in terms of consumption to the economy. And government's infrastructure spending has also crossed all-time levels, which will give further kick. Infrastructure, as we know, the entire length and breadth of the country has gone for a sharp change in terms of all different formats of infrastructure. And that is very commendable because we live in a democratic setup wherein infrastructure execution is a challenge. So having this kind of execution that has been carried out in the last decade is nothing less than a major achievement. Manufacturing, as we know, has been a sharp revival engine in the last few years, with a lot of manufacturing moving from China to India, with something called as a China Plus One strategy. And also, this has been supported by several initiatives of the government, such as PLI, Atmanirbhar Bharat, so on and so forth, which is why the Indian exports have crossed record levels. Mahakumbh, as many of you would have also attended, was not just a major religious event, but also a very important economic event that took place, with more than a footfall of 40 crore people having spent more than 3 lakh crore rupees, which is a phenomenal kind of a sum. And the kind of economic impetus that it had developed to that area and the country is extraordinary. Now, this is all fine, but how can a person, NRI based in Singapore, participate in this resurgent Indian economy? The most convenient means is to investing into Indian equity mutual funds. As we know, mutual funds these days are the most popular means of investing. And an ideal portfolio into mutual funds should be based on the investor profile, the risk appetite, and the financial goals that the person has in mind. And SIP, as I mentioned, is a very important and a widely accepted tool these days to invest in Indian mutual funds. And the appropriate mutual fund should comprise of all these categories that we have mentioned, is large and mid, flexi, multi, because each one has got an important role to play in the growth of the entire portfolio, as well as the entire bifurcation across different asset management companies is very important. And these are also very important parameters which needs to be kept in mind, like quartile performance benchmark comparison to select a mutual fund. This is the process in which we go for a mutual fund portfolio construction, wherein these are all different categories of mutual funds which are there right now in India. So this is all the factors that I mentioned, which is the financial profile, risk appetite, and the goals. But decide on the different categories of mutual funds, which is large and mid, flexi, multi, and a percentage allocation across each one of them. After which we can go ahead with the process of selecting a scheme. This is a key performance indicator matrix that we prepare for through our research team for selection of any kind of mutual fund schemes. If we are to take this entire basket of, let's say, small cap funds in India, this would entail all the different small cap schemes that are there in India, and would analyze any mutual fund scheme across several parameters, which is the past performance, the bifurcation across large, mid, small, the kind of portfolio turnover that the scheme is going through, the major allocation across different sectors, the different financial ratios, underlying stocks, the total amount that is managed. Once the investment is done, and it is very important to review that portfolio on an ongoing basis rather than holding on to the same portfolio for a long time, because we live in the times of a lot of dynamic trends, and having an agile portfolio is something which is very important. So we review the portfolio on an ongoing basis and suggest any kind of changes that may be required in the portfolio from time to time. This is the allocation across different mutual fund companies, which is also something which is very important, so that we are not lopsided or tilted towards only a few mutual fund schemes or a few mutual fund companies. Moving further, with another means of investing in India is portfolio management service. A PMS is very similar to a mutual fund in the sense that it is also a managed investment vehicle by a asset management company. And what happens is that there is a diversified portfolio of equity shares, which is started in a separate demat or a brokerage account for that particular investor by the asset management company. The only thing is that the entire role of buying, selling, what to buy, what to sell is outsourced to the fund manager. And as such, the ownership of the investment lies to the in the hands of the investor. As someone can select the different mutual fund schemes, someone can also select the strategy that the person wants to go for in case of a PMS, like large cap, mid cap, small cap, or any sectoral theme, basis the kind of risk appetite of the investor. How is it different than a mutual fund? This is a very common question that we come across. There are three main factors through which it is different. Number one, a PMS portfolio is much more concentrated, meaning comprising of fewer stocks than a mutual fund. While a mutual fund comprises of at least 50 to 100 stocks in the underlying portfolio, a PMS comprises of just about 20 to 40 stocks. So since the portfolio is much more concentrated, the chances of outperformance might increase at a later date. The second difference is that the regulatory restrictions in case of a mutual fund are much higher than in case of a PMS. In mutual fund, there is something called as a sector specific cap or stock specific cap. Well, in case of a PMS, this kind of a scenario might not be there. So a fund manager has got a freer hand to select the kind of stock picking that someone might want to do. A PMS is not impacted by the inflow and outflow of the funds from other investors. Well, since mutual fund is a pool of funds that is there for all the investors, any inflow or outflow by any investor impacts the overall corpus. And a minimum ticket size in case of a PMS is 50 lakhs of rupees. This is the KPI indicator of a PMS that we use for selecting and recommending a PMS strategy. These were the ways to participate in the listed space. Moving further with the unlisted space, as to the space which is before a company taps the capital market and goes for IPO. Let us first understand as to why should someone invest into unlisted shares. The answer to that is quite simple: to catch them young, to take advantage of being the early mover and the investor. Because when these companies tap the capital markets, then there is a lot of demand, not just from the institutional investors, but also the retail investors like all of us, which takes the price of its listing to the next level, which results in something called as a multi-bagger gain. So the kind of returns that we can expect from this could be in multi-bagger like 2x, 4x, so on and so forth. And yeah, so when the company comes for the IPO, then the success story is quite evident. A structured means to participate into AIF is investing into unlisted stocks, rather, is by investing through a AIF. This AIF is like a mutual fund for unlisted shares. So just as a mutual fund selects a portfolio of different shares, AIF would select a portfolio of few unlisted shares of all different types: a startup, a mid-stage company, a late-stage company that is going for IPO, by an experienced team of fund managers, which identify these opportunities at very attractive valuations. And the minimum ticket size is 1 crore rupees. And all these fund managers have got a deep expertise of picking and selecting the right opportunities that are there in this ecosystem of unlisted shares. And the investment in AIF is with a lock-in, because the exit takes time. So the entire journey from investing to the exit takes about 5 to 7 years. Moving further beyond the shores of India is that global diversification. As US is the mother market, and the major market capitalization of the overall stock market in the entire world lies in US. It is necessary, just as we are diversifying into India, also diversify in the US market. And we have developed a platform which invests into US stocks and ETFs through a broking partner in US that we have called DriveWealth. And the way it works is that there is no account opening fee, there is no brokerage on any kind of transactions that are done, any other kind of charge. There is a fixed fee that is there of 1.18% on the total portfolio value, which is charged. And the funds are remitted directly from Singapore to US, so there is no implication of any Indian taxation. As Singapore does not have any kind of taxation on investment income, there is no tax implication there, and US also does not have any tax on capital gains. So as such, it becomes a tax-free kind of investment, no any other kind of implication that is there. This is the snapshot of the platform that we have developed, which is very user-friendly. It has got all the different kinds of parameters that someone might be looking at. These are some of the sample portfolios that we have curated for someone to participate in the US market, which is bases all these themes like EV, FANG MT, which is the Magnificent Seven, the so-called most popular tech giants, and certain other companies and other portfolios that we have curated. So if someone is not aware as to what kind of stocks someone should be looking at, these are the different kinds of portfolios which we have curated for them. Moving even further is the concept of retirement planning. A lot of people that we interact with, especially from Singapore, have got plans to relocate back to India at some point of time, maybe after a few years or after retirement. It is great to have this kind of a plan and to have that kind of affinity towards the motherland, but it should be coupled by sound financial planning. And this retirement planning is done through both the ways. It can be done through fixed income and also through equity-oriented options. Through fixed income, it is possible through the guaranteed income plans, which are there, which are very popular these days in India, which are available for very long tenures, as long as 30 to 40 years. And the kind of returns which are coming and flowing in are also very lucrative. And there's also flexibility in terms of designing the timing of the outflows and inflows depending upon the financial life cycle of that particular investor. And this entire income, whatever is arising, if it is planned in a certain way, is all tax-free in India. And irrespective of whatever are the changes that are happening in the stock market or whatever, this kind of a planning is available. And the second is through equity-oriented option, that there is a systematic withdrawal plan that can be done through mutual funds, which has got tax efficiency. The balance corpus can keep growing with the growth of the financial markets, and there's flexibility in terms of increasing or reducing it with time. Certain practical insights that I wanted to share, especially which we come across from many of the NRIs, is number one, investment into real estate in India. A lot of NRIs based in Singapore plan to invest in real estate in India. It might look very lucrative to participate in Indian real estate, but we must keep in mind that liquidity for any real estate in India is a major challenge these days. And managing that real estate property is also a very big hassle. I use the word hassle because when we face it, we realize the kind of challenge that we come across. The entire process of investing, disinvesting, and then remitting those funds back is all possible and within the four corners of the law, but it requires a lot of time, efforts, and it might at times becomes quite tedious. And the next generation of most of the people who are living even in Singapore, they are not intending to relocate to India or even to visit India on a frequent basis. So managing this immovable property might be all the more challenging for them, considering this fact. And leaving a legacy of a portfolio of real estate property might not be a good idea in that case. And unless someone is planning to use this property for self-use, it might make some sense. But otherwise, financial assets are a much better means rather than real estate to invest and participate in Indian growth story. Depreciation is also been a very major challenge for any person who is investing, especially from Singapore or any other part of the world, and then we receive a lot of concerns about it. The one thing which we must understand is that the major depreciation of this currency that has happened of STD, of INR against the STD is more so in the last 1 year. So, and this is on account of the global change that is happening, especially with respect to US, the kind of governance and the policy that the US is influencing the entire world is the reason why this has happened. If we look at the time before that, let's say 2023, 2024, 24, and beyond that, then the depreciation had been at a very staggered pace. But because of the fact that the USD, the US currency, has depreciated sharply against SGD, Singapore currency, which is why the impact has also been felt in INR. So for any individual who is investing out of Singapore, whether someone is investing in USD or INR, the person has felt this depreciation loss as such. and the differential between the depreciation of SGD in USD and in INR has been very little. So, irrespective of whether a person is investing in US markets or Indian markets, a person who is based in Singapore has faced this. And if we are to annualize this across the last 10 years, then it is at the rate of 3.77%. And moving further, considering the kind of inflows that India is witnessing in terms of FII investment as well as FDI investments, we feel that the demand for the Indian currency will be much stronger vis-a-vis any foreign currency, which is SGD or USD. It is why the depreciation further on might be at a very staggered pace, even if it is there. Gift City is a very interesting development which has come up of late in India, and not many people surprisingly are aware about this development of Gift City. And it is quite interesting that the entire concept of Gift City is very similar to Singapore, meaning this Gift City is a global financial center, first of its kind in India, called as the International Financial Services Center. And the vision of the Indian government is to make it like any other global financial center, like Singapore, DIFC in Dubai, Hong Kong, so on and so forth. So there are a lot of tax concessions which the government has given to all the activities that are happening through the Gift City. As such, geographically, Gift City is very much a part of India between the cities of Ahmedabad and Gandhinagar, where we are based as such. But from the viewpoint of the exchange control law, it is not a part of India. And there are a lot of income tax benefits which the Indian government has given to activities that are rooted through the Gift City. This is how any person who is based in Singapore or any other part of the world can take advantage of through the Gift City. The minimum ticket size as on today is 150,000 US dollars to participate in the Indian markets through the route of Gift City. And any global investor, be it any Indian origin individual or any partnership firms, trusts, corporates based out of India, can invest in the Gift City funds, which are registered in the Gift City by Indian mutual fund companies. And the idea of these is to pool the money and go through a funnel kind of arrangement, wherein this entire fund, which is called as alternative investment fund in technical terms, is like a feeder fund or a fund of fund. So the idea is to they pool money and invest in the same mutual funds in India, which we have all been investing since a very long time. The advantage is that there is no tax implication in India, and there is also no requirement of obtaining a PAN, filing tax returns. Tax assessments would naturally not arise in that case. And also there is no requirement of opening any kind of a broking account or a bank account in India in this kind of case. And there is a direct remittance of funds from the foreign bank account, let's say in Singapore or any other part of the world, to the Gift City fund and vice versa. And the investments are denominated in USD, and the onboarding process is also very simplified. So to summarize, this is how it would work, wherein any investment is done in India through these AIFs based and registered in the Gift City, which would invest in the Indian mutual funds, which invest further in the Indian equity shares. And whatever is the gain that arises out of this is tax-free to the Gift City fund as well as to the investor. So there's no tax implication at all in India, and these funds can be repatriated back seamlessly. So these are the advantages, to repeat, that there is no tax implication in India. There's no requirement of opening even any demat account, bank account in India. Investments are denominated in USD. This basic KYC that is done. So before we end, message by our PM, wherein he has emphasized on the strength of the people. When we refer to people, we not only refer to the people in India, but people across the globe, the entire Indian diaspora, all persons of Indian origin. And where he emphasizes the importance of empowerment of these people And once all people, all the entire demography of India has got confidence in India and participates in India in a meaningful way, only then the economy will grow. And when we can say that we become a prosperous nation and a developed nation by 2047, which is the vision of our PM. Basic disclaimer that all the views were personal, and wherever we have used any data, we have used the relevant references. The entire presentation we would be sharing with all of you over WhatsApp or email. So you can have a look at it and come back to us if you have any questions. Basic about us before we move to the question answer session. We have a legacy of more than 65 years being a one-stop solution provider. The team strength of more than 60 persons in all domains of finance with active office presence across the western belt of India, the cities of Ahmedabad, Rajkot, the GIFT City, and also Mumbai, managing more than 1,000 crore rupees of assets, predominantly the Indian markets through mutual funds and PMSs, and also in the global markets through in US, as I mentioned, for more than 5,000 clients across 26 plus countries. Now, these are the services that we provide. Number one, Indian investments into all these kinds of avenues, mutual funds, PMS, AIFs, also the US markets. End-to-end investments is something that we are into. GIFT City Solutions, we also have our operational office in GIFT City now. We provide advisory on all the kinds of investment opportunities in the Indian stock market through GIFT City funds, income tax and estate planning. In terms of compliance, we are into end-to-end compliances, right from obtaining a PAN to handling tax assessments at the highest level, as well as planning the entire income tax affairs for any person to mitigate the overall tax liability, as well as accounting wherever it is required. Indian estate planning, which is preparation of bills in India. As I mentioned, it is important to comply with the Indian succession laws for all the assets that are based out of India and private trusts wherever there is a need to do so. We are insurance brokers as well, so we deal with all kinds of life insurance offerings in India. We work with all the insurance companies because we are registered brokers. International tax compliance is something which is very important, as we understood that India has got a DTAA with Singapore, and there are a lot of benefits under this treaty that any person based in Singapore can avail of. So we help in someone in interpreting this DTAA and taking utmost benefits of it, along with the compliances that may be required. Financial regulations advisory comprises of repatriation of funds, planning for any other kind of financial transactions in India. Banking related coordination, so we help in coordinating with respective banks for any kind of operational processes that might be required. Now, the advantage for anyone who is working with us is that, number one, there's a single point of contact for anything and everything that they can think as far as Indian financial affairs are concerned. So in other words, we like a family office to them. And this is all possible through a relationship manager from our team, who is a single point of contact backed by all different specialists from financial domains. This brings a lot of convenience to the person who is working with us and also to us in terms of giving a holistic financial advisory, and eases the tax compliance because the data is completely available with us. So far as our charging mechanism is concerned, all these ancillary services that I mentioned, be it income tax, estate planning, international tax compliance, regulations advisory, is all complimentary from our side. We do not charge for it at all, as long as the investment portfolios are managed by us. If any one of you happens to visit any of these locations, then we would be glad to meet you in person. And as I mentioned, we already had a successful event at the Singapore Swimming Club last year. We also plan to have another one later this year. This is our new corporate house that has come up recently, and we have a very strong team across all these locations. So we'll be really happy to meet you in person. Thank you so much for sparing your valuable time, that too on a weekend. And if you have any questions, we'll be more than happy to answer.
Rajit Bhai, thank you. There are quite a fair bit of questions in the chat group. If you can help us address some of this, would be very kind of you. Thank you.
Sure. So let us start with the first one by Mr. Amit. I have my PAN obtained before becoming NRI. It's now I am OCI. Do I need to update anything in PAN card? One thing which you can do is that you can check your status on the Indian income tax portal, if whether your PAN is operative. If it is operative, then there is no issue at all. The only thing is that you need to update your status in the Indian income tax portal as a non-resident. You need to file your tax returns as a non-resident. A PAN that you might have obtained as a resident is fine, is valid, and will remain as it is even when you become a non-resident. The only thing is that you need to check the status of the PAN and your overall status that is mentioned in the income tax portal of being a non-resident. And naturally, the tax returns that you will file further should be under the non-resident status. The second question is by Mr. Deepak on IRS. I find only a C.E.O certificate of residency. Is it okay instead of TRC? So C.E.O certificate is certificate of residency. It is a tax residency certificate. So both things are one and the same. That is what is required to claim the DTAA benefits. Bill made in Singapore is acceptable. Yes, it is acceptable as I mentioned, but it should have the valid, all the essential elements of a valid Indian will. When I say a valid Indian will, it should be as per the Indian Succession Act, wherein it should be mentioning about all the different assets that are there in India. It should be signed by the person who is making the will, and there needs to be two witnesses who sign to it further, and this has to be done in presence of a notary public in Singapore. And then ideally, as I mentioned, there should also be affidavits, which are declarations by both the witnesses that the will was prepared by the person who is making it in sound state of mind. And registration of will is optional in India; it is not mandatory. Moving further by the question by Mr. Nimit Sheth, is it advisable to have a global will or separate ones for India and Singapore? Ideally, we would say that it is advisable to have a separate will. That is what we advise our clients across the globe, not just in Singapore, but across in all the countries. Because what happens is that whenever there are physical, especially immovable assets in India, then many of the times there's something called as a probate that needs to be obtained in the Indian court of law to discharge that succession in India. And the physical copy of that original will may have to be submitted. So it might be practically difficult to do that if there is one global will. If there is a separate will document that is prepared in India for the Indian assets and in Singapore for the balance assets, maybe of the in Singapore or in the other parts of the world, that should be more suitable from the viewpoint of practicality that might arise at a later date. Question by Mr. Nikhil Oberoi. Are capital gains or withholding tax applicable to investments? Just one first question. Are capital gains or withholding tax applicable to investments made via NRE account? The only difference between an NRE and an NRE account as far as the taxability goes is that the interest income which arises from NRE account may be in the bank NRE account or NRE deposits is tax-free in India. Otherwise, whatever investments are done, whether from the NRO account or the NRE account, the tax treatment is the same. So the only this benefit is there from the NRE account as far as the taxability of the income is concerned. So yes, capital gains, withholding tax, everything is applicable, even if the investments are done through the NRE bank account. Question by Mr. Mitchell, are all mutual funds available via GIFT City route? There are at least 10 different asset management companies as on date, as we speak, who have started their funds from the GIFT City. And we have onboarded investors, a lot of investors for practically almost every one of them, which have got good quality funds. So I would say not all mutual funds, but a lot of them, especially the most celebrated mutual funds have started their GIFT City funds or will be doing so in the next few months going further. Mr. Tejal Desai, for returning NRI, how long they can maintain NRI status or RNOR status before they become resident. Okay, so once a person relocates to India, then in that year, depending upon the number of days of stay, it could be determined whether a person is a will become a RNOR or a NRI, and it also depends on the number of days of stay in the past years that is to be looked at. So I may not be able to give a generic answer because it needs to be evaluated depending upon the facts of the case. But to give you a ballpark idea of it, for the another 2 subsequent years, the ongoing financial year when the person has relocated, and at least for the 2 subsequent financial years, a person will have the RNOR status for sure. The person might have a RNOR status in the third subsequent year, meaning the ongoing year when the person has relocated, 2 subsequent years, and the third year a person might have a RNOR status depending upon the stay in the preceding financial years. So 2 to 3 years for sure, and the fourth year depending upon the number of days of stay in the past year, a person can continue to have a RNOR status before becoming ordinarily resident in Indian income tax. What changes in tax laws made in India applicable to NRI? So the new Indian income tax law has just received the President assent yesterday. So as such, the idea of this new income tax law was not to change anything meaningful in India in terms of the income tax and to cause a lot of disruption, but was to simplify the language of the law and to ease out the provisions which are redundant by now and improve the compliance mechanism. So this was the major agenda. So as far as the structural taxes are concerned, tax changes are concerned, then there haven't been much changes for an NRI. However, we plan to organize another events in the next few months, wherein we'll be specifically covering on the topic relating to changes in the Indian income tax law, or we might come out with other content related in form of messages or videos, specifically covering any changes that we need to keep in mind once this is all done, and this would be applicable from the next financial year. This is 1st April 2026. Can income tax return by Mr. Ajay Bharania of last 5 years be filed to claim back TDS on bank savings interest? If yes, is there any late filing? So the income tax return to claim a refund if for the taxes that are deducted, if that is the objective for filing the returns, then the only return which you can now file is 24-25, the last financial year. All the financial years prior to that, you can only file and revise the return if you want to increase the tax liability. If you want to pay anything to the government, then only then the government is now wanting to accept your returns. Otherwise, the government is not going to give you any kind of refund for any TDSs that have been deducted prior to the last financial year, which is 24-25. So I don't think there is any further need to answer the late filing penalty or any other things now. By Mr. Deepak, regulation allows to move some funds when an is settled. Yes, as I mentioned in the presentation, funds to the extent of $1 million can be moved from the NRO to the NRE account per individual per Indian financial year from April to March. So that is possible, and there is a procedure doing so in terms of a certification that is required and needs to be submitted to the bank. If returning back to India forever is monthly amounts pension received from Central Provident Board to be shown as income in India, because Singapore it's not taxable as capital receipt. I'm not sure what is meant by Central Provident Board. I'm assuming it is a body in Singapore. If it is so, then as long as a person is a RNOR in the RNOR status for the first 2 and 3 years, and if that person is receiving that pension outside of India and then remitting it to India, then there will be no tax implications because only the Indian incomes will be taxable in this case. However, either if a person is receiving that pension directly in India or is receiving after a person becomes a ordinarily resident, which is after those 2-3 years of holiday that a person receives, then it will be taxable in India, even though it might not be taxable in Singapore, because either any income which is received directly in India from any source from a third party becomes taxable irrespective of whether a person is an NRI or a resident or whatsoever. And if a person is an ordinary resident, the way I am being living in India, then the global income is taxable in India, and the Indian government does not recognize any kind of exemption which is given by a Singapore-based uh, entity. I think we'll take up maybe one or two questions. Thereafter, because of the time constraint, we can end the session for today, and then we would be more than happy to engage on a one-to-one call, either over Zoom or personally, as you may deem fit.
Rajit Bhai,
Sure.
not to interrupt, my wife Dipali, she has a question. Probably it looks a little bit, we will take it offline, but just as a start, it's a very senior friend and a client of ours. He's a Singapore citizen, Indian origin. Wife, who is Singapore PR, has recently passed away. Substantial assets in Singapore and India. Son is a Singapore citizen, and the family is non-Hindu. So basically, that's the trickiness. The Singapore citizen, the father, I mean, the fellow whose wife passed away is also in his late 80s. They have some assets back in India.
So they have sold the property, and the property was divided by husband and wife both. Wife have received the money, and she has done some investments and everything. So now they don't have will. They have only done the nomination, and the nomination is son, who is Singapore citizen. So how should she get the money here, or
because she's no longer around. So I think liquidity getting back is getting a challenge. So
and even on the taxation part, like they have filed the taxation, and because it's a long procedure, right? You don't get the reimbursed like as soon as it takes a while. So how does it work like?
Right. So as far as the succession is concerned, all the persons who are the nominees, as far as the bank accounts are concerned, the investments are concerned, they'll step into the shoes of the person who is deceased, and they'll become the custodian of those assets. So the ideal way of going about it is that the person who are nominees, they intimate the financial institutions about their death of the individual and claim custody of the investments, and thereafter they can get all the powers and the accesses of controlling those funds and investments, and moving it across the way they want to. We can advise on a case-to-case basis depending upon the type of assets, but this is how it will broadly look like as far as the financial assets are concerned. As far as the immovable property is concerned, then there is, depending upon the state where the property is located, maybe Maharashtra or Gujarat or wherever the property is located, they'll have to go through a procedure in terms of obtaining a particular title to the property. So all the successors have to go through something called as a heirship certificate, which is required to claim the title of the property, which will be dependent on the location where the property is situated. And with the help of a local civil lawyer, they can claim this title through a process that needs to be done. And thereafter, their name would be entered in the revenue records, which will give them rights to sell that property or do any kind of activity that they want to. So this is how broadly it will look like for both these categories of assets. Now, depending upon the individual asset, we can suggest them and guide them the further consequences for taxation as well as repatriation. This is how the succession will look like.
Thank you. I would have some questions. Maybe I take it offline.
Sure, definitely. I think we'll take the last question by Mr. Tejal Desai, which is after becoming resident, foreign income will be taxed in India. If yes, what is the foreign income has loss can be adjusted in this India? Right. So the way it would work is that for the first 2 to 3 years, as I mentioned, the foreign incomes will not be taxed in India. Thereafter, what happens is that the global incomes become taxable in India. So naturally, later on, if there is a loss that might have occurred for any kind of investments that are done, then that loss is eligible to be set off against the gains. The only thing is that it needs to be substantiated in terms of the cost of acquisition, and the loss has to be proved to the satisfaction of the income tax authority. But yes, if there is enough adequate documented evidence, once a person becomes an ordinary resident individual after that 2-3 year period, then that loss can be availed as a set off against other gains on the global incomes that might be arising. Thank you so much to all the participants who have spared their valuable time. And it's always a pleasure addressing all of you and helping as much as we can. And thank you so much to Bhavesh Bhai for bringing all his friends and all his associates who wanted to have this knowledge. And we look forward for many such meaningful interactions and sessions going forward, both virtually and physically.
Thank you so much, Rajit Bhai. For people who wish to liaise with Ashutosh Financial Services, Rajit Bhai, please take note. Premji has put the details there, or you can get in touch with me and I can connect. Thank you once again, Rajit Bhai, Daxesh Bhai, and Premji Bhai, for your very, very detailed, relevant, and insightful session. And we look forward to seeing you again in the near future. Thank you.
Thank you.
Thank you, everyone. Yeah.